All right, guys, you're all welcome to our Forex um masterclass where you'll be learning everything you need to know about the Forex market and every secret that you need to know to be profitable in the market. All right, so I want you to all right, let's just keep on going as we learn everything. All right, so let's start here. What is Forex? What is Forex? Probably you have heard about Forex or you have read, you know some things about Forex, but let's look at it. What is Forex? Now, you see, Forex is short, or FX, you can call it FX or Forex, is an acronym which stands for foreign exchange. So it's just like a global market that we come together to exchange currencies, all right, foreign exchange. And what we exchange is currencies, all right. So it's a global decentralized market where we exchange currencies. It doesn't have any physical point of exchange, and the market is not really controlled by maybe someone like maybe your broker or something. No, it is decentralized market where we exchange currencies. All right, what controls the market are the forces of supply and demand, and the participants, the orders that are being placed in the market, all right, by various participants. So this is what is referred to as trading. You know, when you come to the market and you are buying or you are selling a currency, is what is referred to as trading. You might be particularly, maybe you are buying a currency from someone that is selling it to you, or you are selling a currency and someone is buying it from you. You know, that's what is referred to as trading. All right. So the market is open 24 hours a day, 5 days a week, and closes on the weekends. Yes, the market has times for openings and closing. All right. On the weekends, the market is closing on the weekend, so you won't be trading on Saturday and on Sunday, except for particular brokers that will allow you to do that. All right. So the typical Forex day is split into three main trading sessions. We have the Asian session, we have
Yes.
the
So
European
um,
session,
let's look at
and
the
we also
currencies, all
have
right?
the
Since we are dealing with currencies in
American
the market,
session.
let's look what are currencies. What are the currencies we are talking about?
So the currencies that we are talking about, there are different currencies in the market, more than 100 of them. But let's just look at a few. Just like different countries have their own money, their own currencies, right? So, and we are also trading, you know, with different countries' currencies. So the US dollar used in the US, like the US dollar used in the US, the euro is used in the Eurozone, the pound used in the United Kingdom, the yen used in Japan. All right, so these are all currencies, right? Each currency has its own abbreviations as used by market participants. So they have a standard abbreviation that the whole market participant use. And for example, the main ones include the USD for US dollar. So you are going to be hearing USD, Euro, USD, or the euro for euro. You can see the way it's written just in three letters. You see that. So the GBP for the pound, UK pound, the AUD for the Australian dollar, the CAD for Canadian dollar, and the CHF for Swiss franc, and all and many more. All right, we have many more. We have the NZD for the New Zealand dollar, you know, and many more. We have the JPY for Japanese yen, all right, and many more in the market, all right. So, what are currency pairs? So now these currencies, they are not traded alone in the market; they are traded in pairs. They are traded in pairs. So currencies are traded in pairs. Example, we pick currencies and we pair them together. So I'm also going to be in a video where I'm going to be explaining the minor pairs and the exotic pairs. All right. How do we come up with the pairing of the currency? But I want you to understand here that currencies are traded in pairs. So for example, we have the euro, like we said, and we have the USD. Now, when you pair the both of them, you have the euro USD. So when you let's say for example you want to buy a currency, you are saying you are buying a currency. What you are actually doing is that maybe you are buying the euro now. Okay, maybe you want to buy the euro. You know, so what happens is that whenever you are buying one, you are going to be paying with a currency, right? So if you are buying the euro, what you are doing is that you are also giving out the USD. So for each exchange rate, there are a set of two unique currencies, just like we said that they are traded in pairs. So for each exchange rate, we have a set of two unique currencies. You can also see here in my screen the Euro USD here at 1.35361. This is like what we call the exchange rate, what is exchanging at. All right. So the one on the left hand side is called the base currency, and the one on the right hand side is called the variable or the quote currency. So we said the base currency is denoted in a single unit, one. All right.
The variable fluctuates in value.
Let's move on. So let's say how do we trade? How do we trade? Now, coming to this point, let's look at how do we trade. So let's just give an example. Let's say the Euro USD trade at 1.07258. If I am to exchange 1,000 euro into dollars, how much dollar will it be? Euro, I have 1,000 euros and I want to exchange it into dollars. How much USD will I have, right? So what am I doing here now? I have 1,000 euro. It means that I am actually, I want to exchange it into dollars. It means that I am giving the euro to receive the USD, okay? I'll be offering the euro. What I'm doing, I want to receive the USD, right? So what I need to do is just to, this is 1,000. So I'm going to be multiplying it by the exchange rate, which is 1.07258. 1.07258. So let me just go to my calculator. Calculator 1000, 1.07258. So I'm going to be having 1.072.8.58 USD. Okay. So I'm going to be having 1.01. No, it's not 1 point. I'm going to be having, let me take this off. What I'm going to be having is 1.072.58 USD. So what does this actually mean? What does it actually mean? It means that I'm using 1,000 euro, right? I have 1,000 euro, but when I want to exchange that 1,000 euro to USD, I have more US dollars. Okay, I have more US dollars. So we can actually say that that means that the euro appreciated relative to the US dollars. All right, the euro appreciated relative to the US dollars because with my euro I can have more dollars, right? Because like I said, that the base currency is denoted in a single unit, which is one, right? And the code actually fluctuates in value. It fluctuates in value. So now it has moved from that one to 1.07258, right? So anytime I'm exchanging my euro, for example, this I'm exchanging 1,000 euro to dollars, I'll be having more US dollars. Okay, that's it. So when trading Forex, there are two positions that the trader can open. These two positions are buy, which is long, or sell, which is short. So when we say we are buying, we are longing. And what we mean is that we are saying that the currency is going to appreciate in value. And when we say we are selling, what we are saying is that the currency is going to be depreciating in value. So for example, if we say we are buying, what we are saying is that if we say we are buying, let's say the euro, the USD, and we are buying, what we are saying is that we are going to be having an uptrend like this, and the currency is appreciating. Now, when we say we are selling, what we are saying is that we are going to be seeing something like this in the market. It's going to be depreciating, which is called short or longing. So when a trader buys or longs a pair, the trader is taking the base currency and is giving the variable like I've explained. Now when the trader goes short, the trader is selling, giving the base currency and also taking the variable currency. Simple as that. So let's have another example here. Let's say you buy 1,000 euro with the exchange rate of USD trading at 1.0500. To buy this 1,000 euro, you will require 1,500 USD, just like we did the calculation where we multiplied the 1,000 euro by the exchange rate, which is 1.0500. And when you do that, you have 1.050 when you have 1,050 US dollars. Let's assume that after a week or two, the price appreciates from this to this, from 1.0500 to 1.0800. When you change your euro back to USD, the 1,000 euro that you are now selling will give you 1,080 US dollars. Remember, the exchange rate was at 1.0500 and it gave you 1,050 US dollars. Now it's at 1.0800 and it's giving you 1,008 and 1,080 US dollars. So if you are to calculate the profit, you will be having $30, which is 1,880 minus 1,050 US dollars, which will be giving you 30 US dollars. All right. So in Forex trading, when you buy, you are saying that the price is going to appreciate and it's going to be bullish. All right, that's what we mean as bullish. Now, when you sell, you are saying that the price is going to depreciate in value, and that's what we refer to as bearish in the market. So it's just basically how this is what Forex, this is what we are doing. We are buying and we are selling. It's just, so let's say you are like a normal trader that goes to the market, buys goods and probably sell it for a higher price and makes a profit. It's as simple as that. It's as simple as that. And you can do it, buy at a lower price, sell at a higher price. You are selling at a particular price, wait for it to still maybe drop down in value and take out your profit from it. That is what we do in the market. So thank you for watching. Have a lovely day.